Hello, everyone. I'm Jason Thomas, Executive Editor of SC Biz News, the media company serving about 100,000 business executives throughout South Carolina. Welcome to SC Biz TV and the latest episode in our ongoing video series, Coffee With. Today, I'm having coffee with John Price, member, Tax and Advisory Services with Scott & Company. Based in Columbia, Scott & Company has been recognized as a premier accounting, tax, and consulting firm for over 25 years. John, thanks for joining us today.
Appreciate you having me, Jason.
25 years, that's pretty impressive.
Yes, it is.
So let's just jump right into some of these tax issues.
Sure.
All right, so what is cost segregation and how does it benefit the taxpayer?
So cost segregation is where you take some mainly real estate property and say, okay, I want to try to break this down into components.
Okay.
So, because what most people do is when they buy a building or construct a building is they lump all the cost into one number. And then for tax purposes, if it's a non-residential commercial building, then you have to depreciate that over 39 years.
Oh.
If it happens to be a residential rental property, it's a little bit shorter life, 27 and a half. But still, that's a long time. I mean, no bank is going to give you a 39-year loan. So
Unfortunately, right?
Yeah. So then what you do is you can go in and say, okay, well, you can have a study done. It says, well, some of these pieces of this building are not really structural in nature. They have other uses.
Okay.
And so you can break that up into smaller lives so that some of this stuff can be 5-year asset or 7 or even 15, which is like land improvements. And then you can depreciate that over a shorter amount of time, which then gives you that after-tax cash flow, so that you don't necessarily have to spend 39 years waiting to write this off. And it doesn't have to be done right when you either construct the building or purchase it. I've had clients that had purchased buildings in 5-10 years before. And then they found out about this and said, hey, can this be done? Sure. Because what the IRS allows you to do is to basically catch up the depreciation that you should have taken at using this study and take it all in that year so that you catch it up and you don't have to just, if you didn't do it when you did it, then it's too late.
Okay. So cost segregation, is it just related to real estate?
Pretty much, yeah. I mean, there's certain things that you could. I mean, it's really just breaking real estate down into components that are more personal property
Gotcha.
nature. For tax purposes, you depreciate over a short amount of time.
Gotcha. Makes sense. All right, moving on. So tell me, what changes were made to retirement accounts that became effective in 2023 and beyond?
Yeah, so the Congress passed the Retirement Secure Act, I believe it was 2.0 is what they called it. And there's a couple of changes that are applicable to a lot of folks. If you are let me explain required minimum distribution. So if you have a 401k, IRA, those type of retirement plans, you are required to start taking money out of those accounts at a certain age.
Right.
Well, up until this past year, once you turned 72, you had to start taking money out. Well, starting this year in 23, it's 73. So if you actually turn 72 this year, you got to basically another year's worth of time to let your account kind of catch up back from what happened last year in the market. And then once that you reach 73, then you have to start taking money out. And that's based on the value of your account at the end of the prior year divided by an actuarially decided factor, and says, okay, well, you take that value divided by that factor, and that's the amount that you have to take out. Now, they also increased the age to 75 in 2033.
Okay.
So that's not obviously that's a little ways off, but that's another thing. Couple other things is they also, right or wrong, a lot of people have not saved properly for retirement.
Raising hand.
So in 2025, if you are age 60 to 63, you're going to have a greater, what they call catch-up contribution that they're going to allow you to do. Instead of right now, currently, you can make up, if you're aged 50 or older, you can make a catch-up contribution, what they call it, of an additional $7,500 right now. And starting in 25, if you're in that 60 to 63 area range, you're going to be able to do 10,000 instead. So you're just adding some more to it to allow you to, if you're able to, go ahead and kick that in and let it, then if you're 60 and you do that, then you're going to have another 13 years of hopeful growth before you have to start getting it back out.
So there's hope for people like me who haven't maybe set aside as much as they should.
Yes,
All
yes,
right.
yes.
Tell me though, why does the government make us take out our savings when we reach a certain age like that? It's like they're penalizing us.
They need the tax revenue. So because you've deferred the tax. So let's say you started out at 25 and you started out and contributed to a 401k with pre-tax dollars. Then hopefully that is grown, but at some point they're like, okay, we want that tax that you quote saved back then. We want it back now. Now there is there's also the Roth option, Roth IRA, Roth 401k, where you can contribute to that. It's not deductible when you make the contribution, but when you start taking it out, not only is the contribution that you initially put in not taxable, neither is the growth. So that's the beauty of a Roth. And I would recommend probably some who are younger and not having a lot of taxes currently to probably go that route because they're not really saving a whole lot now. But then, possibly they could look at either continuing that Roth throughout their job career or maybe switching over to a pre-tax 401k. But anyway, the Roth is a great deal. In fact, I actually did it for my daughter, who's now 15, and she had a little job and was getting some wages. And I said, okay, well, we're going to open up a Roth for you, and had her put her savings in there. And now she'll have that 50 plus years from now, and it'll all be tax free.
So that's a big difference between the Roth and the 401k. Interesting.
Regular, yes, sir.
Doing some homework here. Appreciate this. I got a Roth, but I need to figure out.
Okay.
I got the 401k too, so got them both going on.
Oh, well, one other thing that the change is that currently or in the past, if you had employer matching that your contributions, if you were contributing to a Roth, their match had to go into a pre-tax account. Now you're going to be allowed to ask the employer, hey, I want you to put that into my Roth instead of a pre-tax. But the caveat is that you will then pay tax currently on whatever that match is. So you're still paying the tax on it just like you are your own contributions, but it'll grow tax free.
All right. Let's switch gears here for a second. So why are Medicare premiums so much higher than last year?
Well, I get this question a lot from some clients. They'll say, what happened? Why did it happen to my Medicare premiums? Medicare bases the premiums they charge on your adjusted gross income from 2 years prior. So, for instance, if you filed your 22 tax return, they're going to take that. They're going to look at that and say, okay, well, this is what you're going to be charged on your Medicare premiums for 2024. So if you have an unusually high income year in, say, 22, your premiums are going to go up, and it could be substantially. And they're going to be like, well, John, this was an unusual year. I only had this one time. I mean, it could have been you sold your business or you had a large retirement distribution for whatever reason. Well, you can go back to Social Security Administration and say, look, I would like to appeal this premium increase. You really can't do it until they tell you about it. And then you go back to someone and say, look, I had a life-altering event, or I retired from my job or whatever. And that you can give them some facts. Now, whether or not it's not an automatic thing, but they will look into it and decide if it's appropriate to then reduce that premium. But a lot of folks don't realize that their Medicare premium that is charged is based on their level of income. So I just, I think that's something I hear about. I get that question a lot. So I just wanted to explain that.
Yeah. Medicare going to be around 20 years from now when I retire? Social Security, all that.
Well, I mean, it'll be around. I just don't necessarily know that it'll be around at the same level that those folks that are enjoying those benefits today are. Because we are, as a society, living longer.
Sure.
And there's not as many workers as there used to be. So it's kind of like it's a double-edged sword here. Is that we've got fewer workers, but more people drawing, and for a longer time.
For a longer time, yeah.
So that's something that needs to be corrected.
That's have to be corrected at the federal level.
Yeah, well, yes, Congress has to do something about that, but none of them are willing to do something that might hurt somebody's pocket.
Yeah, for sure.
That would be casting a vote for them.
Mm-hmm. Got to think about elections.
Mm-hmm. Yep.
All right. Well, speaking of elections, let's talk a little bit about law here. So what are a couple of changes to South Carolina's tax law that were applicable for 2022 and later?
Yeah, so we don't really have any major legislation for 23, but I did want to point out a couple of things for 22 is that the South Carolina individual income tax rate, which has always been 7%, the top rate, was decreased to 6.5% in 22. And then there's a provision that says we will then drop that rate another 0.1% for the next few years till we get it to where it's at 6%. So presumably it'll be 6.4 this year, but there's a caveat in that you have the government has to say we project that our general fund revenue will increase 5% from the year before, and if they feel like that's going to happen, then the rate will decrease.
But if it doesn't,
then the rate stays where it's at that time. So. Therefore there's incentive to make sure that they find enough revenue in the budget to get it up to that 5% increase so that we can drop the rate 1.1%. I don't know whether or not that's going to happen every year, but eventually we're getting to 6%. And then the other major change that's not necessarily applicable to the general population, but it's a win-win for those who are drawing retirement from military is they do not pay a single dollar of South Carolina tax on military retirement income that they receive. It's something that we felt like the state said we want to reward those who served in the military and are receiving retirement benefits. So we will not tax a single dollar of that, just like Social Security benefits are not taxable in South Carolina as well.
What's the biggest benefit to a resident like myself that tax rate goes down?
It just puts a little more money in your pocket.
Sure.
Some people noticed that last year because it went from 7 to 6.5. So that, it has a large incremental change so that they got a little more in their refund or owed a little bit less in taxes last year. I admit South Carolina's withholding tables have never really been accurate in that I'll have clients who end up owing federal money, but they're getting state back. And they've never understood it other than the fact that they're just having more withheld than they're needing to be withheld. So, it's a nice surprise at the end of the year when you get, I get some money back from state, which typically then helps pay the federal.
Robbing Peter to pay Paul.
Exactly. Yep.
All right. Let's talk about selling a business. What are some tax considerations to ponder when someone wants to sell a business?
Yeah, so there's, a lot of people, when they have a business, they're selling the assets of the company, not the stock or the units if it's an LLC. They're selling the assets. Well, depending upon what type of assets you have that you're selling will determine the tax treatment for you. So if you have real estate, equipment, inventory, those things that are what we call hard assets. that's treated one way for tax purposes. Whereas if you're and what we call an intangible asset, customer list, goodwill, name, those things, that's treated as an intangible asset, and that has a different tax treatment. So you want to obviously take as much of the sales price to your inventory first, because that's really, you've got those costs, and that's not going to cause you much in the way of any taxable income. And the IRS has laid this out many, many years ago and said, okay, you have to have what they call a purchase price allocation. So you start with, most people don't sell cash, but if they did, that's dollar for dollar. And you work your way down to inventory, fixed assets like, vehicles, computer equipment, furniture, real estate. And then you get to the bottom, which is this name, goodwill, customer list, and non-compete. And so it depends, like I said, so for the stuff that's fixed that you can put your hands on, that's deemed to be ordinary income and would be taxed at whatever tax rate you have that for you personally. The intangible asset is deemed to be capital gain property. So then you pay less tax because of the capital gains tax rate. So I've had a couple of clients that sold their businesses this year, and I work with them to, okay, well, you want to give, you want to put as little to that part as you can and more down here because it saves you taxes. Now, on the flip side, the purchaser wants more sort of up top and less down here because they can depreciate the stuff up here or write it off a lot faster than down here because this intangible asset that they're acquiring, they have to wait 15 years before it can be fully written off. Whereas, say, a truck is 5, computer equipment's 5, furniture is 7, inventory, they're going to just turn around and flip and sell it and, not have really much in the way of any income from that. Mm-hmm. So there's competing interests. So you can't just say, oh, the buyer says, well, I'm going to allocate this much to it, this, and this. And the buyer and the seller's like, well, no, I'm going to do this. And they have competing interests. So the IRS is like, no, you two are going to have to agree to this. What are you doing here, 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 and here? And then you got to file a form. Both of you have to file a form saying, here's the allocation. Mm-hmm. And they have to agree, or you could have issues.
A lot of ducks to keep in a row there.
Yep, there is. I mean, it's not, a lot of people are just worried about getting out.
Yeah.
And not so much worried about that. And I've just seen it where if they had a little forethought and said, let's talk about this instead of after it's over, then it's like, oh,
too late.
Too late, and we've made a mistake.
Do you see federal tax laws changing in the near future?
They're going to have to. And the reason is the current law we have now that was passed back in 2018, I don't know how many people understand there's certain provisions in that law that expire at the end of 25. Now, was there going to be anything happen between now and 25? Highly unlikely, because what do we got next year? We got an election, presidential election. Everybody that's running in for the House is running, and then a third of the Senate. So it's not likely that there's going to be any tax legislation to any major extent next year. So then in 25, they got to get busy, because otherwise, if they don't, at the end after 25, a lot of things are going to revert back to the way it was before 2018, like tax rates that were lowered. They're going to go back to where they were before. Now there's give and take here. Personal exemptions went away. They'll come back. The limitation on the deduction for state and local taxes which is currently capped at $10,000, will go away. But then the greater standard deduction that a lot of people are enjoying now would get decreased. Also, the value of someone's estate that you can pass on to your heirs, estate tax-free, would get greatly reduced. Right now, it's like, I'm rounding, but you could pass on $12 million of value to your heirs, and there's no estate tax. After 25, that number is going to probably get cut maybe at least by half or maybe even more.
Really?
If they don't do anything.
Mm-hmm.
And then there's also the other big thing is there's an active trader business deduction that individuals are enjoying now that would go away. So something's going to have to be done. They're not going to just say, oh, well, we're going to go back to what we had before, because that probably is not going to fly. It's not.
Should be interesting.
So
I'm just curious, will there be a day you think where somebody like me who wants to file their taxes can hop online, the IRS's website, just do it all in one and just be done with it?
Oh, sure. I mean, a lot of people could do that now.
Oh, really?
Oh, yeah. I mean, the IRS is getting to where they're trying to get less paper. They're going to start digitizing paper returns that they receive in a couple of years. And I mean, they encourage people to electronically file. Now, and we're going to get to the point where every single person is going to be able to do their return. I don't know. I doubt that, because they're never going to simplify the tax law that much to where everybody's just filing. We talk about filing a postcard. I mean, I told people that would listen, I would love for that to happen, and I'd go find something else to do. I felt like I could, but now that as you can see, I got a little gray hair on me. I don't necessarily know I really want that, because I have a few years left on me. But I mean, if it did, it did. But I just don't think that's going to happen.
Yeah,
there's too many competing interests in Washington. This is, oh, well, you can't take away this, or you've got to do this. And it's, unfortunately, that's just the way it is.
Sure.
So.
Gotcha. Anything else you'd like to add today?
No, I mean, we covered all the topics, and, I just wish everyone, we're in the middle of August and it's warm, but, the holiday season is going to be here. So I wish everybody happy holidays in here coming up soon.
Absolutely. John Price, member, tax and advisory services for Scott & Company. Thanks so much for being with us today.
Appreciate it, Jason.
All right.
Thank you.
That'll do it for this edition of Coffee With. For more interviews like this one, visit our YouTube channel at youtube.com/scbiztv.